It's finally summertime. While you're watching this video, I'm actually hiking Mount Kilimanjaro, so that's kind of crazy, right? What better time when the market slows down, the earnings season is over, is to review your portfolio and look at some undervalued stock that you can add to your portfolio and probably make a little bit more money going forward. The Canadian stock market has been pretty good with us lately, especially because it was supported by the energy sector. And I'm saying good not because you probably didn't make much money since the beginning of the year with your Canadian stocks, but when you look at what happened on the US side, Canadian market has held its hold of the bargain with a lot of energy, so great protection against inflation. And today, I am here to show you a few of my favorite stocks that are not trading at crazy valuation. Dividend growth investors, bonjour, my name is Mike Iru and I'm the founder of Dividend Stocks Rock. I'm also a passionate investor that has this YouTube channel to help you invest with more conviction so you can enjoy your retirement. So don't forget to give me a thumbs up, subscribe to the channel to not miss my Thursday morning video. And today we're going to talk about 5 of my favorite Canadian stocks that I would buy right now if I didn't have them in my portfolio already. So let's get started with a classic. AlimentationCouche-Tard. For each company, I'm going to tell you what I like the most about it, what makes it unique, and why I think it's undervalued. One of the way that I look at valuation is to look at the historic of the PE ratio. Why? Because I don't believe too much in valuation, to be honest, because it's just a matter of playing with numbers. And I could spend 5 hours doing my calculation, and a CFA right besides me will do the same thing. We're going to end up with 2 different numbers for AlimentationCouche-Tard, and in 5 years from now, we're going to know which one was right. So instead, I'm trying to look on the trend, and what I've done is I've filtered some stocks that has a very strong dividend triangle, so revenue growth, earnings growth, and dividend growth, as you can see on this graph, and a P ratio that is lower than the average. And this is exactly what we have seen. I've already identified AlimentationCouche-Tard a while back in 2021, telling you how it was cheap. Now you can see that the P ratio is slowly going back up, but there's still room for improvement, especially for a company that is able to grow double digit and you're only going to pay 18 times the earning. That sounds like a very good deal. What makes AlimentationCouche-Tard so special? It's its ability to adapt. For a long time, they used to grow by acquisition. You know, convenience stores, highly fragmented market, they're a leader. So they were just buying, integrating them, and they have an amazing model to improve the profitability of each convenience stores. This is what they did for a long time. So historically, 70% of their growth was coming from acquisition. And now moving forward, we're talking about 40% acquisition, 60% organic, which is quite a move. One of the reasons is it has been more difficult to make good acquisition, because it's one thing to just write down checks, but management team at AlimentationCouche-Tard is highly disciplined and highly experienced. So they're not going to buy stores just for fun. So they will plan ahead. They have a very strong balance sheet, a lot of liquidity, so they're ready to make a move, but they're not going to pay any kind of stupid price. Instead, they will focus on organic growth in the meantime. The transition from ICE vehicle towards electric vehicle is happening already. It's going to take a long time. So while they're making very good money with fuel because they have healthy margin, they will also focus on installing superchargers and making sure that people comes into convenience stores where the real money is and buy snacks, buy alcohol, buy tobacco, buy all of those products while they are waiting until the car is fully charged. And I think that this ability to adapt the business model, to transform and always go forward, they don't wait. I mean, they bought convenience stores in Norway several years ago as a laboratory to know what's going to happen with superchargers and electric vehicles. Keep in mind, Norway has 14% of all cars that are electric, and they have been able to adapt their business model and their stores to make sure that they continue to make a lot of money while consumers' habits are changing. So for that reason, I think that AlimentationCouche-Tard will be a super interesting stock to hold for several years. Full disclaimer, this is one of my favorite stocks. This is one of my largest positions in my portfolio. But keep in mind, those are not financial advice. I'm not telling you to buy AlimentationCouche-Tard. I'm telling you to do your research and make sure that you understand what's the business model and if it fits with your investing strategy. Moving to the second one, which is not in habit for me to talk about energy stocks. You know, I don't like them that much, and then you're gonna call me stupid because you've been making so much money for the past 2 years. But if you've been investing in energy stocks for the past 5 years or the past 10 years or the past 15 years, you're not making that much money. So it's highly cyclical, and most of the time the problem I see is a lot of those companies, they skyrocket, and then the price of oil crash and they are short on cash flow. They get more debts, they cut down their dividend, and they're not being such a great dividend growers. There are exceptions though. You already know that I love Enbridge. I don't have Canadian Natural Resources in my portfolio yet, but this is one company that shows an impressive dividend triangle, and most importantly, it has went through multiple oil busts and has kept its dividend growth streak alive. We're talking about more than 20 years for Canadian Natural Resources, which is very, very impressive. You can see earnings is going up, revenue is going up, and obviously dividend is going up, while you're going to pay roughly 11 times the earnings, which is not that bad. So what makes Canadian Natural Resources a better pick than most companies? Well, the thing is, they are sitting on an amazing asset. So that's the biggest advantage they have. They can line up their production along with commodity prices, and as long as it's higher than 35 bucks a barrel, they're making money. So when it's now trading over 100 bucks a barrel, they can produce like there's no tomorrow. They're racking up cash flow like it's crazy, and then they just sit on their reserve and they just produce a little bit less when commodity price goes down. So its ability again to adapt to the market makes them a good cash flow machine regardless of the commodity price, which is pretty rare in the energy sector. And this is why I like CNQ so much compared to the rest of the sector. So there are always exceptions in any types of section or any types of rules. CNQ would be definitely one of my picks if I have to invest more money into the energy sector. Now let's go back to banks, because we cannot talk about Canadian stocks without talking about banks, right? You already know I'm a super fan of National Bank, but I'm going to show you why this one is so special. Well, first you look at the dividend triangle, it's quite impressive. So revenue, earnings, dividend is through the roof. One of the best performer over the past 3, 5, 10, 15, and then 20 years across the big six. PE ratio under 10 right now, so you're not paying much for that growth. An amazing balance between a yield and growth potential. And now, when you look at the business model, what I love is they have about 1/3 of net income coming from classic banking activities, so personal and banking. And then they went through multiple growth vectors. Going forward, wealth management will be super important. This is where the money is. People are wealthy, they have complicated financial situation, and they seek for advice. Yes, you're gonna tell me, oh yeah, well, I'm just paying like 500 bucks a month in an ETF and I don't need those stupid advice. You're right. But the day that you're going to have a business, a divorce, and 3 companies and 5 children spread across 2 wives, maybe you would like to have someone to sit down to optimize your taxes, make sure that your estate is in order, and who's going to take care of your businesses when you sell. So for those rich people, which complex financial situation, wealth management will be there. Another of their growth vector, financial markets. A lot of money is happening over there. We're talking about liquidity, we're talking about investment. There's a lot of trading happening, and National Bank happens to be a leader in this market. They're very strong in Canada, and you can see 1/3 of their net income is coming from financial markets. Now, this is a place where you can make a lot of money, but it's highly volatile. So sometimes it doesn't mean that maybe one day they're gonna make a false start and they will have a bad quarter. We saw that with BMO a few times already. So National Bank is not shielded against that. finally, they decided to grow internationally, which is kind of interesting because Scotiabank has been doing that for several years and failed to outperform the other banks with this narrative. However, National Bank has been able to do something very smart. So first, they acquired a supra-regional bank in Cambodia, which has a similar position as National Bank in Quebec. So ABA Bank is a very strong bank in Cambodia in a small region, small market. So they are used to see how they can improve their business model and even make even more money. So that is doing very well. And the other acquisition they did, it was Credigy in the US, which is a specialty financing company. Again, they're going with niche market instead of going broad and say, oh, we're going to be the biggest bank and doing the biggest loans. They focus on those niche market with high growth potential. One stock that we have identified in 2016 at Dividend Stock Rock was TFI International. Way before they became popular, way before they bought USP Freight, but now they're still showing a very strong dividend triangle, so revenue, earnings, and dividend increasing, but the price to pay, 11 times the earnings, sounds a bit too low to my taste, so I'm pretty sure that there's something wrong, right? Well, the thing is, there's nothing wrong with TFI International. It's just that the market is pricing trucking companies for a recession, which kind of makes sense. I'm pretty much expecting a recession by the end of 2022. And if it happens, obviously, trucking will be one of the sectors that will suffer the most, because if people don't buy stuff, they don't need to transport it. Keep in mind that this is the best timing to buy this type of business, because once the economy comes back up and there's no more inflation, or the inflation is under control at least, well, you're going to see TFI International skyrocket once again. Why? Because they have this business model where they operate in a highly fragmented market and they acquire many competitors every year to make it grower. They scale that, so they benefit from economy of scale. They are top of the line to optimize their trucking services and their profitability compared to other peers, which makes it a very special investment, because they are one of the largest trucking company in North America, but they are like the one that is the most optimized. So they are able to make more money because they're bigger, and more money because they're more efficient. And for those two reasons, they now have trucking lines in Canada, in the US, and in Mexico. So they are all across North America. So moving forward, betting on later in the market is always a good thing. So definitely moving forward, it's probably a very good timing to look at TFI International. Now, let's take a look at the last one, but not the least. However, I must warn you, we're talking about a small cap, which means a lot of fluctuation and you have to be very careful. Canadian Net REIT is still trading on a TSX Venture. We're talking about very small cap. You see our revenue, total trailing revenue is like $20 million for a full year, which is nothing. FFO per share, kind of shaky, but always going up, and the dividend is going up as well. What I find interesting is you cannot look at the P ratio when you're talking about REITs, because earnings doesn't matter, but you can look at the average yield. And as you can see now, it's starting to go up, meaning that the business is doing well, but people are not ready to invest in a small cap right now. Remember, since the beginning of the year, with interest rate rising, people are starting to sell growth stocks and buy blue chips and value assets. Canadian Net REIT as a small cap with geared towards growth, grow their FFO per unit double digit, grow their dividend double digit, not exactly meeting a stable and big business profile. However, they are quite interesting because they have spread across multiple stable tenants that tends to renew. Companies like Metro, Sobeys, Walmart, a lot of grocery stores in their top tenants. So they're going to be there for almost ever, say long-term contract for their leases, And then the way it works is Canadian Net REIT has its focus on growth by acquisition, and they focus these types of tenants all the time. So because they're smaller, it's easier to grow double digit. Obviously, if they had like 50 billions in assets, it could have been a little bit more complicated, but now they're super small. They can go fast, and that could be a very interesting play in the REIT business. So again, 4% yield, and on top of that, you have double-digit growth. That's pretty rare on the market, and you probably should look into it. Again, small cap, lots of volatility. It can go up, it can go down very quickly. You have to be careful. So I hope that you have enjoyed this longer than usual video, but I mean, top 5 takes some time, right? In the coming weeks, I'm going to do same thing for the US one. So make sure that you subscribe to the channel, give me a thumbs up to make sure to spread the good news, right? And I'm curious about your preferred undervalued stock right now in the Canadian market. So get in the comment below, let me know about the stock that you prefer, that you think it's not getting enough market love right now, and we're gonna talk about them. It's going to be interesting to spread some new ideas with our community. And until the next video, which will be next Thursday, don't forget to stay invested.